So when I first went into John Paulson's office when I was at Wells Fargo Family Wealth as a due diligence analyst, it was far and away the most successful hedge manager I had ever met at that time. And I was, back of envelope calculating how much is 1 hour of John Paulson's time worth. It's less about the money. It's more about the intelligence and the influence that this hedge fund manager world kind of creates in this like super unique, very kind of private ecosystem.
Okay, so Lindsay, it's great to finally have you on the podcast. Thank you so much for taking the time early in the morning.
It's great to be here. Thanks for having me.
So Lindsay, you're the head of Western Region Prime Finance Sales at BNP Paribas. What is Prime Finance Sales?
My clients are hedge funds and they come to me for all of their financing needs. I'm also the quarterback for their relationship to the rest of the firm. So that can be across anything from equity, derivatives, trading, cash trading, all sorts of esoteric financing needs. My clients will come to me as the first stop on their way into the firm to access leverage effectively.
And you're based in the Bay Area, so...
I am. I'm based in San Francisco. My coverage is Western Seaboard and sometimes as far east as Denver. So really Denver West. Majority of my clients are in California between San Francisco Bay Area and then Los Angeles as well, with a few in Seattle as well.
And why didn't you choose New York? Because New York seems to be this.
It's a great question. No, I love that. So New York, I honestly feel like it's one of the biggest misses of my career, not having spent at least a few years in New York City.
Yeah.
The hedge fund community in the West Coast is really, really small, and it's quite easy to be sort of a big fish in a small pond quite quickly, just given the size of the community, which I now love. The community out here is super, super tight. We all support each other and help one another across sell side and buy side. So it's been really, really great. New York is obviously the epicenter of the hedge fund universe. So I do spend a lot of time in New York City with my colleagues. And also many of my larger clients have New York offices in addition to having headquarters in California or Washington.
And then what does your day-to-day really look like? And how big is your team?
Every day is different. Very, very different, especially over the last few years. I joined BNP Paribas as part of the Deutsche Bank prime brokerage acquisition a few years back. So I came over with 1,000 of my closest colleagues from Deutsche Bank back in December of 2020. And we've been growing the prime brokerage business together ever since, as BNP acquired Deutsche's prime business to kind of get back into the financing realm. I was at Deutsche Bank for a very quick 4 months, following close to 9 years at Bank of America, where I held very similar roles across prime sales and capital introductions prior to that. No 2 days are the same in this role at all. It's really, really interesting. The client asks that come in, it's playing defense with helping clients figure out problems and really meet their financing needs. And there's also days where we're playing offense and bringing new products and ideas out to our client base and the street. So it's really, really variable. In my role, I do a lot of entertaining, going to conferences. It's part of it, getting the branding out there and really communicating the messaging to the marketplace that BNP Paribas is fully in the financing business. And we're in super growth mode globally too. So that's made my job a little bit more different with doing some more media stuff in addition to the day-to-day blocking and tackling with client asks.
And you've been in the industry for the past 2 decades, right?
Yes, don't age me, but yes, it's coming on 20 years, which goes by really, really fast. I started my career in research,
right?
Long only research. I was an analyst at U.S. Trust. And I was doing long only research within the wealth management space, moved over to Wells Fargo Family Wealth, where I was in hedge fund research, hedge fund manager due diligence. So effectively doing due diligence on hedge fund managers so we could add them to our platform for ultra high net worth families to invest in. So I spent the better part of 3 years at Wells Fargo Family Wealth, where I met a few thousand hedge funds during that time period. I was the junior analyst on the desk, taking first meetings and really being the filtering mechanism for the rest of the team to take on second and third and fourth meetings, which would eventually lead to investment. It was a really fun time to be there. I actually joined Wells Fargo Family Wealth in hedge fund manager due diligence right before the financial crisis. So
Wow.
Friday, September 13th of 2008, I signed my paperwork and turned it in. And then obviously we all know what happened on Sunday, September 15th, 2008. It's a very interesting time to kind of bottom tick getting into hedge funds. And the whole world was blowing up around us, it felt like, over the following 6 months.
Right.
And so really being ground zero and kind of epicenter of what was going on in financial markets through the lens of hedge fund managers was a really formative experience and formative time to be in manager due diligence and research. I wouldn't change it for anything. It was so fun. And also now I got to meet so many interesting hedge fund managers when they were just coming out of the gates, or they were pre-launch, or they were new launches. And now some of the biggest hedge fund names in the world were managers that I got to meet back in 2008, 9, 10, 11. It's pretty cool.
Almost like you grew up together.
We did. Yeah, we did. Some of these big multi-managers, multi-strats that, are now 10, 20, $30 billion I've known since they were born, basically.
Wow, I love that.
So it's fun. It's cool.
And how have you seen the industry change, or even the range of services that you have provided your clients with change over the last few years?
They've evolved, but not super quickly. I mean, hedge funds have been around meaningfully since call it the early 2000s. If you can go further back to the 60s, 70s, and 80s, and there's a few, variable examples, tiny examples. When I first got into the hedge fund space, hedge fund industry AUM was, right around 800 billion. And now, fast forward 15 years, and now we're approaching, especially after the recent market rally, we're approaching 5 trillion in industry assets.
Wow.
So it really has been up and to the right, despite all the negative headlines around hedge funds always. I feel like that's the only constant is press reporting negatively about hedge funds. I mean, you can occasionally find some positive reporting, but it's I'd say the exception, not the rule.
Yeah.
So industry asset growth has been phenomenal. It's been great. And there's been new entrants into the prime brokerage space. There's a prime broker for everybody at this right. juncture, which is awesome too. And then also the service provider landscape has also grown meaningfully. So I think the industry is probably a whole nother podcast to talk about the full evolution of the industry.
Yeah.
But I'd say following COVID, the barrier to entry to starting hedge funds actually become much lower.
Right.
Prior to COVID, you'd have to have minimum 150 million in AUM to support a real hedge fund business. And you'd have to have all the major players in your business in-house. So for example, CFO, CCO, COO, you'd have to have those players in-house. Now you can outsource a lot of that for more cheaply. And also office space is the other major thing for day one. So office space and personnel. And now people being able to work from home, work remotely, not have to have that office space anymore is a paradigm shift that's enabled more entrants and more funds to come into the hedge fund ecosystem.
Including the amount, does it still have to be 150 million or no?
No, I could say the magical break-even number is significantly less than that. So sub 50 million now.
Oh, wow.
With the outsourcing options available.
Oh,
yeah,
wow.
so that's great.
Yeah.
I mean, the industry is still call it 95-5. So I'd say that 95% of assets in hedge funds come from 5% of hedge funds. And that's a trend that we're continuing to follow, especially being in RC, being lenders to the larger hedge funds in the street. It's something we're hyper focused on.
Yeah.
We also try to figure out the next generation of hedge fund managers coming on. It's important to support that next gen, because that's going to be who's going to be our major players again here in 10, 15, 20 years. So our capital introductions team and our prime sales team are covering the globe trying to find that next gen talent who will be, the next AQR potentially.
Right. And what's very interesting is that you're based in the Bay Area, and some of the pitches that I saw even at the Sohn conference were about technology companies, right? And so is this a new thing that there are many hedge funds that are tracking technology as a sector, or are there multi-strategy funds that are focused on technology and other themes as well? Or what are you really seeing?
Sure. So by the nature of being in the Bay Area and being in California and being in like Silicon Valley, there's a lot of tech-focused long-short equity managers here. Tech, TMT, obviously AI has been a big theme recently. So yes, to have an overweight in a portfolio towards technology based on geographical location in
Yeah.
California, I'd say is very, very normal. And that's remained unchanged throughout the last 15, 20 years that I've been in this business.
And what percentage of the endowment portfolios are allocated in hedge funds today?
I'd say it's been pretty constant, if not growing, a growing part of their overall portfolio.
Yeah, got it.
I mean, you think about it in two ways. I mean, here's how I think about it. There's hedge fund beta, which is the multi-strats, and the hedge funds that are really investing in a more market neutral way, where they can turn out 10 to 15% returns annually, regardless of market movement.
Yeah.
That's, in my mind, that's hedge fund beta. University endowments seek hedge fund beta as part of their portfolio. Many of them do. The other part of the portfolio where it's still a hedge fund, even though it's something very different, is the part of the portfolio where they're looking for unique alpha streams. So litigation finance, private credit, airline financing, esoteric quant streams. I mean, there's different ways they're looking for that hedge fund alpha, so that they can, across a diversified portfolio, approach or exceed their return bogey annually to support their university needs. But I'd say, are hedge funds going anywhere as part of the asset allocation?
Right.
No. I think also to enter the consultants. Many endowments, many larger investors will leverage consultants in their due diligence process. And all of the consultants I cover are very, very consistently invested in or recommending that their clients are invested in hedge funds.
Actually, a lot of our listeners are also, people who may want to get into hedge funds at some point. And they are trying to differentiate for themselves what is a private equity firm, what is a multi-asset manager, what is a multi-strat hedge fund, and stuff like that. So I almost see that there is some convergence in terms of the strategies when it comes to, say, the large private equity, names that we hear about, say Apollo or Blackstone, et cetera, and then hedge funds, right? You just talked about private credit and all of that. So how do we really differentiate, or is there more of a convergence, and should we call them multi-asset managers, multi-strategy asset managers versus calling them multi-strategy hedge fund managers or private equity, or what does that look like?
No, sure. So all of those things that you mentioned sit under the umbrella of alternative investments. So historically, go back 100 years or further, and it's stocks, bonds, cash would be the portfolio. Then all of a sudden enter alternatives. So it's basically everything that's not just long only stocks, bonds, cash, effectively. So within that umbrella, you have hedge funds, of course, private equity, private credit, venture, real estate, real assets, and kind of the list goes on. So my world really is the hedge fund piece. With that being said, over time, hedge funds have begun to create many, not most, but there's definitely many that have created private funds or side pockets that have become SPVs or have become more private equity or venture vehicles where they can invest in private markets because they view the opportunity within their sector to be within the private markets. It's very, very common, actually. In the tech space, many tech funds have successfully launched private equity or venture funds alongside the main strategy of the hedge fund. I'd say it's less common to have a private equity firm go and start investing in public markets unless you bring a team in to do that. So by definition, hedge funds invest in public markets, where a majority of the securities they're investing in have daily marks, and you can see it all on Bloomberg. That's really it. And they go long and they go short, and they're basically trying to capture 80% of market upside and 20% of market downside. In a sentence. If they're doing a good job, that's what they're doing, in my opinion. It's hard to do that over multiple market cycles. But yes, hedge funds invest in public securities. Full stop. Asterisks, there could be a side pocket, which is private equity or more from private investments. Could be one off or could be part of the strategy.
And interestingly, we've seen a similar, as you said, right, venture capital and private equity investing in public. So Sequoia, for example, it has a patient capital approach where it has started to invest some of, or at least stay invested in some of its companies that it had invested in earlier in private rounds, and then that's their transition to public versus public only. So that's something that we've seen on the private side as well.
I think that's right, because it's also how do they the Sequoias of the world, how are they providing a solution to their underlying client base who might want that public market exposure, are after, a Facebook goes public, they want that exposure to Meta in the long term.
Yeah.
Even though it is a public company, the thesis is still holding that they want to stay long that name.
Yeah.
So yeah, you're right. Devolution, it does make sense from that perspective.
Yeah, absolutely. So traditionally in the venture capital spaces, there is a concept of power law where the idea is that only a couple or a few of your portfolio companies will give you blockbuster returns, or they may just return the fund. So how should we think about the performance of hedge funds, and what is the unfair advantage or the moat that a hedge fund needs to have to outperform?
So hedge funds typically are more diversified. And if you look across a hedge fund portfolio, the idea is that most names that you're investing in will have some sort of positive return profile, which is you're right, dislike what you've mentioned in venture. I think more so in venture than in private equity.
Right.
With, of 10 securities or 10 investments, 1 or 2 are going to hit it big. If you're going to break even, the rest are going to be zeros. If that was the batting percentage in hedge funds, there would be no hedge funds in the world. If 70 or 60% of the investments were going to zero. So hedge funds largely, depending again on what strategy there is, because there's a dozen or more different types of hedge fund strategies, are going to have a broadly diversified book,
right?
Where there's position level and concentration level limits, where you might have, max position size is 10% of NAV. And so therefore there's a rule set in place that really is the risk management toolkit that really governs how the hedge fund is invested. There's things like stop losses in place. Right. So you can't, lose 40% of your overall portfolio on one position that goes sideways. Also, if you think about it, when shorting, there's unlimited downside.
Yeah.
It takes a really, really talented portfolio manager, especially when markets are ripping up into the right, to figure out how to manage a short book so you don't lose everything on 1, 2, or 3 names.
Yeah.
Which we've seen that movie before. It has happened. So derivatives usage has become a lot more prominent. There's different, tools and tricks that hedge funds employ to really hedge the book where there's a limited downside, which I think is the most important thing to think about.
Makes sense. And in the hedge fund world, does the consistency of return matter more than the absolute percentage of return altogether? Because we've seen different examples, right? Someone earning consistent returns over years, and then someone, returning like say 150% 1 year, and then something else altogether next year. So what?
Yeah. It depends. So there's a flavor for everybody.
Right.
So if you want, if you're a family office, if you're $1 billion family office, and you are putting, call it 10% of that $1 billion into hedge funds,
right?
And this could be a sandbox for you. We're like, this is play money. We don't care if it goes to zero, but we're also very, very happy if we have 5 times return over the next 10 years. Right. That would be great. So it just depends on what you want. If you want to roll the dice and take risks, there's different strategies that you can invest in. Versus if you want that hedge fund beta, if you want that steady Eddie return stream, because it's important to you to churn out 10 to 15% annualized returns, you're a lot more likely to go into a market neutral manager, whether it's one of the multi-strategy funds out there that are all household names, or if it's a quant fund, a large quant fund that's also a household name, where you're taking on very, very little market exposure to generate that 10 to 15% return annually.
You've worked with so many hedge fund managers, and of course, they are very successful. And I also observed that a lot of the hedge fund managers who end up starting their own shop have been very successful in their early careers or college life and stuff like that. What are the most common traits you observed amongst the most successful or your favorite hedge fund managers or clients?
That's a good question. And we think about this a lot, because you think about what motivates people and how people are empowered to take risk. I met with a hedge fund in New York recently. He's a client. They run about $15 billion. It's a credit shop. And I was congratulating him on his success. And he's probably, my age plus or minus a couple of years. And he has been a portfolio manager for 15 years and has done extremely, extremely well. And I asked him that exact question. I said, to what do you attribute your success? And he said to me very candidly, he's like, it's very helpful to enter the working world with, no college debt, and to feel like you're in a position to take risk, because if you fail, you're always going to be okay.
I love that.
So it's almost like an abundance mindset
Yeah.
of being open to taking a risk
Right.
and knowing that you've got that security blanket or that safety net below you should you fail.
Yeah.
I think that's part of it. Another one of my favorite portfolio managers who worked very successfully for 2 decades at one of the biggest multi-strategy hedge funds out there, never hit a down and out, super successful, annualized at 12% with the vol of 8. He's now launching his own fund. She'll keep him nameless, but he knows he's my favorite hedge fund manager out there. And at some point I asked him, I'm like, how have you been so successful? How have you worked for these platforms for 2 decades and never been fired? Because it's an anomaly to never hit,
Yeah.
the drawdown max and be shown the door. And he said, Linz, it's basic. He's like, I play offense, I don't play defense. And it's a really interesting mentality. Same thing, sort of abundance mindset of walking in, being like, I understand the names I'm in. I understand the positioning. I understand the markets. I understand the market influences. I know how to play this game and I know how to do this dance. And so his approach of coming in without fear, I think, is what led to a lot of his success, especially early on when you're in your late 20s and early 30s, really getting into it on your own for the first time, where you're managing your own P&L. It does take a certain level of confidence, frankly.
How do you think they train their mind, and how do you train your mind?
There's not one way. I think you're born with it. A lot of it, frankly. I think you're born with it. I mean, you can see child geniuses who are playing chess at the grandmaster level.
Right.
Can you teach that? Can you train that? No, you can identify a skill and then nurture it and move it along. So I think a lot of the brightest minds in our business were really born a bit different, frankly.
I love that.
Yeah.
You were in a meeting with John Paulson. I actually heard one of your podcasts where you mentioned that. How did that go? What did you learn?
Yeah, I mean, that was early in my career and I was so starstruck. It's so funny. My friends give me a hard time because I see Igor from World Quant and I'm like, oh my God, Igor. And now I'm going to be like horrified if he watches this podcast and sees that I fangirl over him. But it's interesting because in my world, it's like there's the best and the brightest, and they're hard to access because their time is so valuable.
Right.
So when I first went into John Paulson's office when I was at Wells Fargo Family Wealth as a due diligence analyst, it was far and away the most successful hedge manager I had ever met at that time. And again, it was 2000, it was like 2009, 2010. So it was after he had made so much of his money coming out of the crisis. And I was, back of envelope calculating how much is 1 hour of John Paulson's time worth. And I forget what the number was, but I was like, wow, we just took like a few $1 million of his time based on what he had earned in the year prior. And I just remember being so enamored by that fact and just also motivated of like, wow, there's a lot of really bright people in this business doing interesting things, making a lot of money. How can I continue to get involved in this way?
Right.
So it's less about the money. It's more about the intelligence and the influence that this hedge fund manager world kind of creates in this like super unique, very kind of private ecosystem.
Hedge fund managers obviously have a lot of influence, but how do you think they impact companies, or how companies are run, their operations, how does that get impacted, if at all?
It depends. So I think that question, is best suited towards the activist hedge fund manager universe, which are all kind of larger, more kind of public headline friendly names like the Value Acts of the world historically, or Elliott's, who have come in and take activist positions in companies where they get a board seat and they really effectuate change. So I'd say that's the most extreme example of how hedge funds, influence the direction of companies. Activist funds, the percentage of the overall hedge fund universe, not that big. Not that big. I mean, like, I don't know, less than 10%.
Right.
By assets and by number of firms. But still they're meaningful because they hit the headlines as a hedge fund. So it definitely has a trickle down effect to the rest of the hedge fund world. Broadly, if you're not reaching the threshold where you have to file as an owner in companies, I think hitting the 13S, for example, they're just another passive investor for the most part. A lot of hedge funds don't want to be activists. They don't want board seats. They don't want to influence the direction of the company, which I think also differentiates our world, hedge fund world, from private equity.
Right.
Like that's the whole point of private equity is to go and effectuate change. Hedge funds broadly don't do that. They're trying to capture market moves and individual security movements and capture that upside and, find the next Salesforce, day one. post IPO. Like I think that's, or even during the IPO process, trying to get allocation of the IPO and working with sell side desks to be there day one for certain private companies they've been tracking and they want to be involved that they're going public. So, but would they have like a real desire to go in and to change the companies they're investing in?
Maybe.
Activists, managers aside, not really.
And I think that also has to say something to the horizon or the time duration, right, that they invest for. So
yeah.
And making sure that the change actually happens in companies is a really long haul kind of a situation.
Yes, exactly. Exactly. And also too, to make a lot of money in that space too, you have to be hyper concentrated. So if you're one of these big activist shops, your portfolio has, 8 to 12 names only, long only.
Right.
Very little leverage used.
And then the other thing, which is Sohn Conference. So you are a board member of the Sohn Conference in San Francisco. Why did you start getting involved, and what have you learned so far from your involvement?
It's been a really incredible way to give back. I've been on the board for the last handful of years, since right before COVID, actually. And Seth Blackman, our current board president, called me one day and said, "Hey, we're looking to add to the board. I think you should come and get involved." And I said, "Let's talk about it." So went and had a meeting, and the stars really aligned with my participation. It was also helpful that I knew the founders of the Sohn conference in San Francisco, dating back 15 years. So Patrick Wolf, who was part of the Peter Thiel ecosystem and launched Grandmaster Capital, alongside a dear friend, Jack Selby, they started the Sohn chapter 15 years ago. And so I knew them back then. During my time at Bank of America, we're always really supportive of the Sohn San Francisco conference. I had attended the New York Sohn conference a few times and got to know the chapter there as well. So when I got the phone call, it was a very obvious choice to get involved. And then also to, given my history in capital introductions, they were looking to add more allocators to the day, an allocator panel, and getting more LPs in the room. And so that was really the task I took on. And also now too, I've taken over beneficiary selection, which has been really, really rewarding. So this year we added the Posse Foundation.
Yes.
I did the due diligence on adding Eat, Learn, Play, which is Steph and Aisha Curry's foundation. Super fun to work with those guys too. So it's been a growing conference. This year we had almost 400 people in attendance, raised over $500,000 for our Bay Area beneficiaries. And last year we had around 350 attendees and raised around 400,000 of money for our beneficiaries. So it's nice to see the growth trajectory. It's also the premier West Coast conference for the hedge fund universe in San Francisco. There's not too many large conferences out here. So it's really nice to have this be the October event of the year everyone comes to. It's this event, and then also rewind to the Milken Global Conference in May that everybody goes to in Los Angeles.
Yeah.
You can be assured that you will see a majority of the people in our world that you'd like to see between attending Sohn San Francisco and the Milken Conference in LA.
Oh, wow. That's pretty cool. And what have been your biggest learnings, building this, or even failures, if at all?
Oh, being on the Sohn board?
Yeah.
Oh goodness, no failures. It's all positive. It's all positive, right? When you're raising money for the kids, it's all positive. Again, it's just re-underscored the commitment to the West Coast and the whole hedge fund community coming together for a good cause.
Right.
And to all of us, again, supporting each other and loving this industry and wanting to really grow it together and be in it together.
Yeah.
It's beautiful. I think it's a lot more connected than some of the other chapters globally, just given especially the sell side involvement, all the major banks step up and provide major sponsorships in addition to the hedge fund clients as well that come through to donate.
I love the format of the conference, which is that people just present ideas, and that's what you want, right? When so many hedge fund managers get together.
Exactly. Kind of demystifies hedge funds, makes a normally non-transparent world a little bit more transparent. So you can see how various portfolio managers select securities for their portfolio.
What have you learned from your years of building, your team? What do you think makes more sense, or rather, what are the things or what are the variables that people should focus on when thinking of building a large financial services team, or at least a team
Yeah.
that have a large impact on financial services?
I think it comes down to the people. That's
Right.
really it. That's really it. It's all about the people. And even here on my team today, you look across the entire team and it's a really esoteric collection of people across all of different Wall Street organizations. So it's magical because you get
Yeah.
to walk over to the head of sec lending and be like, when you were at Credit Suisse, like how did you do A, B, and C? And
Yeah.
same thing, walk over to the derivatives desk. When you were at Barclays, how did things go? And so you get to really learn from everyone's collective experience from all across Wall Street. Like
Yeah.
it's all about the people. And even now, when we're thinking about hiring our summer analyst class and extending full-time offers to incoming analysts every year, we think very, very carefully about the type of people that we want to bring into the organization. Are they team players? Do they have a positive attitude? They have a good work ethic. They want to be at the desk. They want to be working super hard. They have a client-centric approach. I mean, all of these things, that's it. I mean, it's all about the people.
What is your most memorable interview with someone who you definitely hired, or maybe did not hire, but
Yeah.
the person?
Most memorable hired. Oh my gosh. There's so many stories. There's so many stories. Oh goodness. Is there a most memorable? I adore our analyst in New York City right now, and I'm not going to name her name because I don't want anyone to go and steal her because she's amazing. But I was assigned as part of a formal mentoring program to summer analysts 2 years ago to her. And I had the distinct privilege and opportunity to work with her. We had calls every week to talk about the internship, what she was working on. And it became evidently clear that she had been placed into the wrong city and the wrong division for her skill set. And I said to her, she was in like Chesterbrook in HR.
Wow.
And I'm like, no, like you need to be in sales. You got to come out to New York City, meet the team. You have to join my team. You have to. And so she came out to New York and she met with the entire team and it was unanimous. The entire team was like, we're hiring her. This has to happen.
Yeah.
So it's a certain kind of personality and it's a certain kind of confidence and work ethic that you can just gauge from spending time with people.
Yeah.
So I was really grateful that BNP had paired me with her and that we had the ability to bring her in and hire her to our team. Yeah. So a lot of it's dumb luck, honestly. When you get into this business, people always ask me, how did you find your way into prime sales? And again, it was luck in many, many regards. Even accepting the role at Wells Fargo Family Wealth and hedge fund due diligence, that only ever happened because I knew the head of Wells Fargo Family Wealth. His name was Michael Cole. He's since departed. I emailed him and I said, hey, Michael, let's grab coffee. And he's like, I think I know what you want, Linz. I'm going to send you in for basically a final round interview at Wells Fargo Family Wealth. And I got the job. I had met him during business school in an informational interview, kind of one of 200 that I had during that time period. But I planted that seed. And again, right time, right place. He helped me get that job in that right moment. And I was off to the races in the hedge fund world, which is far more interesting than being in long-only research. No offense to my friends at US Trust, but it was a much, much more interesting experience. But even now, I say to a lot of my mentees, and I mentor at any given moment between 8 and 12 different mentees through my Pepperdine University board connection, and then through formal processes at BNP Paribas. And I say to them all the time, create options for yourself. Have a few different doors you're knocking on at any different moment. Ideally, there'll be 1, 2, or 3 open to you. Then you have choices.
Right.
And even if you choose to stay exactly where you are, you at least feel powerful because you know that there are other places to go and other things you could be doing.
I love that.
And one of those options could be hanging it up and traveling the world for a year, if that gives you joy, or taking the GMAT, applying to business school, thinking about doing the JD MBA, studying for the CFA. But do things in your life that create options for you so you feel like you're the one who's always in control of your own destiny, because no one's going to look out for your career in the way that you will.
What do you think is the key to lasting relationships?
Oh my goodness. Some of my favorite people in this world I've met through work. I mean, it's magical when you go through interesting experiences together and work together 10 hours a day for years and years and years on end. You form a bond with the A team, if you will, that's been
Yeah.
there a long time, depending on where you are. I had it at Bank of America. I have it here at BNP Paribas as well. I think it's connecting and really being altruistic in your relationships. When we have a big win as a team, or even when it's been, me personally, my first instinct is to give it away. I want to share the joy, share the win. Everyone who's involved should take credit. And even if you weren't directly involved, if you will be involved in that relationship going forward, I want those people who I work with to feel empowered to own that win. And so you actually, in my perspective, you end up multiplying the win and the goodwill from that win by giving it away to others and sharing it and giving it away to the team. So really, at the end of the day, being in prime sales, it's a team sport through and through.
What do you do for fun?
Depends on the day. It depends on the day. I mean, lots of different things. I ride horses competitively. It's now become less competitive based on timing. So if you're ever bored on YouTube, you can type in Lindsay Costigan and Mr. Harrison, and you'll see lots of show jumping videos. So
Wow.
Historically, I've competed in the sport of show jumping at the Grand Prix-level. The number of wins on the board. I have a hard time doing anything part way. I'm very competitive. So for me, show jumping has been a big part of my life since I was a child. So I joke that it's my side hustle. I actually just sold a horse yesterday.
Oh,
Yeah,
wow.
and moonlight as a horse trader, and I'm not very good at that, to be honest. I also spend a lot of time with my two kids who are 6 and 9, and try to travel as much as possible, both for work and also personally to see friends and keep that connectivity with my network, which is pretty vast and global at this point, which I love. I've got a very, very, very solid personal board of directors, and I make a point to see everyone at least every quarter.
I love that. What do you think is the most undervalued thing or person or trait in a person today?
I think authenticity, and paging Brene Brown. I mean, vulnerability really is a superpower. I think the ability to express moments of vulnerability in a way that shows that you're a real person authentically, I think that's really undervalued.
Yeah. I think many people actually do not express their vulnerable self because they are concerned about the perception, outside perception,
Yeah.
and because they don't want to come across as someone who's not competent, because of, the historical association with vulnerability. So how can people be vulnerable and show their competence at the same time?
It's a tough one. I feel like all of us experience some level of imposter syndrome. I think you know who you are and you know what to do and you know how to do it. I feel like a lot of us don't give ourselves the credit that we are owed. So I think being prepared, understanding what you know, understanding what you don't know, and not being afraid to ask questions.
I love
That's
that.
really it. Because I think through thoughtful questioning of people who are more senior, experienced than you can build a connection, and also you can learn. It does no one any favors to pretend,
right,
at all.
Yeah.
And so I think also just being confident in that. I mean, I was hired here for my relationships in the region.
Thank you so much, Lindsay, for taking the time. And
Thank you.
I'm sure people who want to enter the hedge fund industry and who want to potentially build a hedge fund will definitely learn a lot from your episode. And I hope to continue the conversation.
Thank you so much. I'm out here to try to make finance cool again. So if anyone ever wants to have a chat about it, I am here. I have an open door policy. Thank you so much.
Thank you. Bye.